In this report, we dissect a landmark $2 billion acquisition that showcases the growing power of clinical-stage asset developers. We'll examine how Boston Pharmaceuticals resurrected an abandoned molecule, positioned it in a lucrative market, and ultimately profited immensely by selling it to GSK. This deal underscores how mid-sized biotechs can create immense value by acquiring, developing, and out-licensing late-stage assets. But first, here's a brief executive summary. In a landmark transaction, GSK acquired global rights to efcamratinib, formerly known as Efimosfermin, from Boston Pharmaceuticals in a deal valued up to $2 billion. This includes a $1.2 billion upfront payment and up to $800 million in milestone payments tied to regulatory and sales targets, plus tiered royalties. Efimosfermin is a once-monthly injectable targeting steatotic liver disease, formerly NAFLD, an area with high unmet medical need, competitive intensity, and significant commercial upside. The compound's development from a shelved preclinical asset to marketed drug exemplifies how mid-sized biotechs can de-risk and reposition assets originally deprioritized by larger pharma firms, creating immense value for both parties. Here's a quick look at the deal timeline. After originating from a large multinational, possibly Sanofi, 𝗕𝗡𝗕𝗟𝗏 was deprioritized and eventually acquired by Boston Pharmaceuticals, who began recharacterizing its metabolic and hepatic potential. By 2021, Boston completed early phase data showing strong metabolic biomarker improvements and liver enzyme normalization, prompting them to seek a large pharma partner. In 2022, GSK exercised its option to license and develop the asset globally, paying $1.2 billion upfront. Then in 2023, the companies announced positive top-line phase 2 data and initiated pivotal phase 3 trials. Pending successful outcomes, the companies aim to file for regulatory approval in 2025. We estimate Boston could receive up to $800 million more in milestone payments based on sales targets disclosed in their press release, plus tiered royalties on global net sales. The exact royalty rates were not disclosed, but similar deals in the space suggest a mid-teens %. Here's our assessment of due diligence conducted by each party. Boston Pharmaceuticals focused on 4 key aspects. First, they identified untapped aryl hydrocarbon receptor, or AHR modulation, as a novel liver disease target. Second, they engineered a monthly injectable format leveraging 𝗕𝗏 chemistry, improving patient adherence versus daily oral alternatives. Third, they emphasized biomarker-driven endpoints, including ALT, AST, and MRI-PDFF, as well as long-term metabolic safety. Fourth, they validated efficacy in a stratified phase 2 population, demonstrating improvement in both diabetic and non-diabetic subgroups. From GSK's perspective, we can highlight 3 key due diligence items. They evaluated competing NASH, SLD assets in the market, such as Madrigal's resmetirom and Akero's EFX. They recognized the unmet need for less frequent dosing and metabolic comorbidity alignment. And third, they would have assessed manufacturability and scalability to support a large global rollout. In our view, GSK paid a rich but justified premium for 𝗕𝗏𝗕𝗟𝗏. We estimate the upfront payment represents a nearly 5x return on Boston's investment since acquiring the asset from Sanofi in 2017. Key strengths of the deal for GSK include 𝗕𝗏𝗕𝗟𝗏's once-monthly administration, validated metabolic and hepatic biomarker improvements, and synergy with GSK's broader cardiometabolic pipeline. However, several weaknesses must be acknowledged. Notably, the steatotic liver disease still lacks validated surrogate endpoints for full approval, making the path uncertain. Also, the market is crowded with more than 15 candidates in late-stage development. Real-world efficacy translation from biomarkers to clinical outcomes remains uncertain. Looking ahead, GSK can pursue opportunities such as expanding into combination therapy markets addressing fibrosis plus inflammation, extending to type 2 diabetes or metabolic syndrome-related liver dysfunction, and capturing share in the large population of patients who require post-NASH diagnosis. Key threats include regulatory ambiguity around endpoints for full approval, which may favor non-invasive over biopsy-based surrogates. Competitive pressure will mount from both oral and weekly injectable options, and payer scrutiny will rise on metabolic therapies with unclear long-term outcomes. In conclusion, this transaction underscores a reverse licensing paradigm in which a mid-sized or virtual biotech licenses an asset from Big Pharma, develops it through targeted clinical development, and sells it back to Big Pharma or another strategic buyer. This approach offers numerous benefits. For the original license holder, even if they retain a royalty, they gain access to large downstream value they couldn't realize internally, reduces the opportunity cost of maintaining shelved compounds, and enhances scientific validation of their IP portfolio. For buyers like GSK, this strategy ensures pipeline expansion without shouldering early-stage R&D risk. Smaller firms can profit from mimicking Big Pharma's resources to execute leaner, more efficient trials with data-driven patient segmentation, clear endpoints, and rapid turnaround times. By developing assets with commercial readiness in mind, these nimble biotechs can position themselves for attractive deals. And when the time is right, they can seamlessly hand off assets to Big Pharma for late-stage development and commercialization, all without incurring substantial capital expenditure. GSK's acquisition of Efimosfermin is a prime example of this evolving dynamic. For larger pharma seeking new growth avenues and smaller firms aiming to monetize innovation, this approach unlocks considerable potential. Thank you for your attention. If you enjoyed this analysis, please show your support. We look forward to your continued engagement.